In this video, we're working exercise 9-9A. We've already worked A and B. In this video, we're going to work part C. To balance in the inventory account, calculate that. Assume that the level of inventory did not change from last year. So what we're making an assumption is that the asset turnover ratio at 10.5 times held constant all through the year. All right, so then that just tipped my hat on how we're going to work this. If you recall from the prior videos, we made note that our total assets equal our total liabilities and stockholders' equity. We've determined what accounts payable is, and calculated retained earnings. And accountants love to put negative numbers with parentheses. So that's a negative $72,000 in parentheses. Now we're asked to determine what inventory is. And you're probably thinking, well, in the first video, we calculated what current assets are, so we'll use that. Well, the problem is we got two variables. So it's hard to get inventory. Now, if we knew what accounts receivable was, we would have total current assets. Bam, we're good. We can calculate what inventory is, but we don't know what accounts receivable is. So we need to go in with another method, okay? And how we're going to do that is we're going to use the inventory turnover ratio. And that's going to give us, and another piece of information they gave us, and that's going to get us into where we need to be. So let's look at the other piece of information they gave us. Let's see where it is. They gave us gross margin, which is 30%. And then they gave us gross margin for the year, which is 378. Inventory turnover we need. So we're going to need all of those, actually. 30, 10.5 times, and 378. So let's get busy. Okay, so we know that the cost of goods sold divided by, we're learning that rather, cost of goods sold divided by ending inventory equals 10.5 times. That's what the problem gave us. Okay, so that means that we have sold our inventory 10.5 times. You know, I worked, and to get through college, I worked at Walmart, third shift. And I noticed, and then I asked, because, you know, I was a business major, the health and beauty aids, you know, where they sell, you know, shampoo and stuff. I noticed that they were always stocking. I'd come in, I worked third shift. I'd come in, shelves would be bare. They start stocking. Next day I come in, shelves are bare. They were literally selling all that stuff in the health and beauty aid section almost everything almost every day. Some things didn't sell that great. You know, they weren't popular items, but largely, they could stock some things during the day, and they had to restock shelves during the day just because they were running out. So they were selling through health and beauty aids 5, 6, 7 times a day. I mean, a week. That's a lot of turnover. They needed a bigger. That's why the stores are bigger now than they used to be. And they were selling them at a loss. They didn't make any money. You go in, you get the super cheap whatever, and while you're there, you buy stuff that makes Walmart money. All right, so anyway, so turnover is an important ratio. So a department and a large store for the entire company, they're useful ratios. All right, so in this case, we're looking at the inventory turnover, and they've turned it over 10.5 times. Again, you know, electronics at Walmart wouldn't be 7 times a week, right? There's just not that much demand for TVs and DVD players and Nintendos or whatever, right? But in other areas, they have to have volume. So some places you have to have volume, some places you don't. Jewelry store will not have high volume. Green beans, canned goods, a lot of volume. Y'all get the idea. So anyway, just depends on what you're looking at, what kind of inventory you're selling, what you're looking at. All right, so we can back in to this. We can get cost of goods sold. We can calculate that. And then that'll give us ending inventory. That's the problem right now. We're trying to calculate ending inventory, right? This is December 31st. Inventory. So we're trying to calculate ending inventory, that's the abbreviation, and cost of goods sold is COGS, that's the abbreviation for cost of goods sold. We're not given the income statement, but the income statement would be sales minus cost of goods sold, that's the cost of inventory that's sold, will give you gross margin. Now we were given gross margin, and I didn't leave myself enough room, so what I'm going to do is I'm going to abbreviate that. I'd already abbreviated so much, I didn't want to abbreviate anything else, but I'm giving up. Gross margin. That is not General Motors cars or, the competitor Ford and Toyota. No, it's gross margin. So we don't know what sales is, but we know if we knew what sales was, we could subtract out cost of goods sold and it would give us gross margin, but we know what gross margin is, 378. All right. So cost of goods sold divided by the ending inventory and then gross margin. So how do I get sales? Because I need to calculate cost of goods sold. So how do I get cost of goods sold? I need to calculate sales first. Okay. So before I'm just going to write it. Well, dadgummit. Yeah, let's do it that way. So I know that, I'm going to write it here. You could write it, what I'm fixing to do right here, but I ran out of room. Gross margin percentage is 30%. Just by knowing that, I can get the percentage for cost of goods sold of sales. What is going on? And I'll explain this to you. This is your vertical income statement. On an income statement, everything is expressed as a percent of net sales. I think I should just probably be clear. This is net sales. So it's expressed as a percent of net sales. So 30% of net sales is gross margin. That would mean, by default, cost of goods sold is 70% of sales. All we got to do is calculate sales, then we can get cost of goods sold. Bam, we're done. All right. So we need to divide gross margin by 378. So 378 divided by 0.3 will give us sales, which is 1,260,000. So I put sales there. So now we can take 0.7 times 1,260,000, or you can take 1,260,000, subtract 378 to get cost of goods sold. Either way, I'm happy either way. I don't care which way you choose. Do both. Make sure you got the right answer. So now we know it's 882. Cost of goods sold is 882. Okay. So I didn't leave enough room here, so I'm going to go above. So cost of goods sold is 882 divided by ending inventory. I don't know what ending inventory is, but I know whatever that is equals 10.5x. Solve for ending inventory. And then an inventory will be $84,000. All right, I'll let you guys do the little bit of algebra there that's needed to calculate ending inventory. And that's how that works. And so you can see how interrelated the ratios are with the financial statements. And so this kind of a problem, maybe not so much applying the knowledge about how to use the ratios as much as showing how everything's related. So combining parts A, B, and C, we have used all this additional information to calculate the missing items here. And it's just another way of working through calculating the ratios and getting a good feel for how they are calculated and how they impact or how they're based on the financial statements. So in this last part, part C, we use part of the income statement to get ending inventory. And this, when I say part of the income statement, I am referring to this. Net sales minus cost of goods sold is gross margin. Gross margin is from the income statement. So it also reiterates how interrelated the financial statements are. So this concludes the video of exercise 9-9A, part C. There were 3 videos prepared, part A, part B, and part C. So watch them as you need them if you haven't watched parts A and B already.